So, let's talk about Bitcoin. What is it really? Forget all the complicated jargon for a second. Think of it like digital gold. It's money, but it doesn't exist physically like the cash in your wallet. You can't hold it or touch it. Instead, it lives entirely on the internet. It exists on a massive public ledger called the blockchain. This ledger is shared across thousands of computers worldwide. Because of this, no single person, no single company, no single government can control it. This is a huge deal. It's decentralized money for a digital world. Now, how does this work without a bank in the middle? Imagine a giant shared notebook that everyone can see but no one can erase. When someone sends Bitcoin, it's like writing a new line in that notebook. For example, Alex sends 1 Bitcoin to Sarah. To make sure the transaction is legitimate, a global network of powerful computers, miners, race to solve a complex math puzzle. The first to solve it gets to add the new block of transactions to the chain, keeping the notebook updated and secure for everyone. This process is called mining. It's not about digging in the ground with a pickaxe, it's about specialized computer hardware mining rigs that consume lots of electricity to solve puzzles. Why would anyone do this? There's a reward. Miners get paid in brand new Bitcoin. This is how new Bitcoins are created and enter circulation. It's an incentive system that keeps the network running smoothly and securely without a central authority. Revolutionary concept in finance. Alright, so we know miners get rewarded with new Bitcoin for securing the network. But here's where it gets really interesting. The creator of Bitcoin, the mysterious Satoshi Nakamoto, built a special rule into the code. This rule is called the halving. It happens approximately every 4 years or after every 210,000 blocks are mined. The halving cuts miners' rewards in half. It slashes new Bitcoin creation by 50%. It's a pre-programmed, predictable shock to the supply. Let's break it down with simple numbers. When Bitcoin first started back in 2009, miners were rewarded with 50 brand new BTC for every block. It was the Wild West of crypto. Then, the first halving happened in 2012. The reward dropped to 25 BTC per block. 4 years later, in 2016, it happened again. The reward was sliced to 12.5 BTC. Then in 2020, it halved once more to 6.25 BTC. And in April 2024, the most recent halving just occurred, reducing the reward to a mere 3.125 BTC per block. Think of it like a gold mine that suddenly becomes twice as hard to extract gold from. Imagine a machine that spits out 10 gold coins every hour. After the halving, that same machine, working just as hard, only spits out 5 gold coins per hour. The amount of new supply entering the market is drastically reduced overnight. That reduction is the entire point. It's designed to make Bitcoin more scarce over time. This controlled supply is what makes Bitcoin a deflationary asset, the exact opposite of the inflationary paper money we use every day. This process will continue every 4 years until the final Bitcoin is mined, which is estimated to be around the year 2140. At that point, no new Bitcoins will ever be created again. The miners will then be compensated solely through transaction fees, which users pay to have their transactions processed on the network. It's the heartbeat of the Bitcoin network. Now, for the million-dollar question, what does the halving do to Bitcoin's price? While past performance is no guarantee of future results, the historical data is, frankly, mind-blowing. Let's look at the patterns. The first halving was in November 2012. In the year that followed, Bitcoin went on an unbelievable run. It skyrocketed from around $12 to over $1,000 by late 2013. That's a gain of nearly 8,000%. Of course, an insane crash followed, but the halving clearly acted as a major catalyst for that bull market. It was the first major test of this economic theory. Then came the second halving in July 2016. At the time, the price was hovering around $650. What happened next? The same pattern played out, but on an even bigger scale. Over the next 18 months, Bitcoin's price climbed steadily before exploding to its then all-time high of nearly $20,000 in December 2017. People who had never heard of crypto were suddenly talking about it at the dinner table. Again, a massive bull run followed by a painful bear market. The supply shock from the halving appeared to kick off another cycle of intense speculation and adoption. The third halving took place in May 2020. The world was in a very different place, but the crypto market followed a familiar script. Bitcoin was trading at about $8,600 on halving day. Over the next year and a half, it embarked on its most significant bull run yet. The price surged to a new all-time high of nearly $69,000 in November 2021. Major companies like Tesla, major companies like MicroStrategy. The narrative of Bitcoin as a legitimate financial asset gained incredible momentum. The pattern was undeniable. A halving event leads to a supply squeeze, which historically has led to a major price rally 12 to 18 months later. The halving isn't just a party for investors, it's a serious test for the miners. Remember, these are the people and companies running the computers that keep the network secure. Their revenue, the block reward, is instantly cut in half. Imagine your salary being slashed by 50% overnight. It's a brutal reality. Miners with older, less efficient mining rigs and high electricity costs suddenly find themselves operating at a loss. This forces them to either upgrade their hardware to more efficient models or shut down their operations completely. It's a survival of the fittest moment for the mining industry. This miner capitulation can cause some short-term volatility. When less efficient miners shut down, the network's overall computing power, the hash rate, can temporarily drop. However, the Bitcoin network has a brilliant self-correcting mechanism. Every 2 weeks, the difficulty of the mining puzzle automatically adjusts. If miners leave and the hash rate falls, the puzzle becomes easier to solve. Blocks keep getting found about every 10 minutes, keeping the network stable and secure. Eventually, the hash rate recovers as efficient miners expand and new ones come online. The key takeaway is the impact on supply. The halving chokes the flow of new Bitcoin hitting the market. Miners are the primary source of new supply. They often sell newly mined BTC to cover costs like electricity and hardware. After the halving, they have 50% less new Bitcoin to sell. That reduction in sell pressure is a huge deal. A less saturated market means any new buying has a bigger price impact, so here we are in September 2025. The 2024 halving is well behind us. New Bitcoin supply has been drastically reduced for over a year. We've seen this movie 3 times before. Each time, the supply shock helped start a powerful bull market that sent Bitcoin to new highs. Now, with more institutional adoption and growing global awareness, the stage is set. Could this be the cycle that pushes Bitcoin past $100,000 and into a new era of price discovery? History suggests the few